Hello, everybody. Welcome to Clef Investments. Let's talk about when you use box to borrow money. What's the term that you want to borrow money? Or basically, what expiration date of the box you want to pick. So if you are new to the channel, you may not know that short box spread is a very good method to borrow money against your stock. You use your stock portfolio as collateral, and you can borrow money with very low interest rate, only slightly higher than the US Treasury bond. And also, all the interests are capital loss, which means it can further reduce your capital gain tax. So you can watch my previous videos in this channel for details. And when you pick the short box spread, because it's option spread, you need to decide what expiration date of the option to use. And last week we talked about inverted yield curve, where the yield for short term is higher than the yield for longer term. But today, let's talk about normal yield curve. And you can see in the picture on the right, the yield becomes higher and the term becomes longer. And this is the yield I copied from the beginning of 2018. The normal yield curve means the longer term bonds have higher interest rate than short term bonds. And the reason this happens is because when you borrow money for the longer term, you have higher risk and you cannot use money for a longer term. So it naturally should have a higher interest rate. But there are also other reasons. Maybe the market believes the interest rate will be the same or higher. So how to pick which term you borrow money from when the normal yield curve happens? Basically, if you can predict the future, if interest rate stays flat, then borrow the short term is better. When the short term expires, everything doesn't change. You continue to borrow using the short term. But if the interest rate rises, then borrowing using the longer term is better because with the longer term, you can lock in the low rate. So if you look at the table on the right, if in the longer term, the interest rate will go much higher than 1.92, then maybe you want to borrow at 1.92 and lock in the low interest rate for 2 years. But we cannot predict the future. So how do we know which one to pick? Use short term or longer term? Let's look at some historical numbers. So in 1993 to 1995, a little more than 2 years, I copied the interest rate from 6 months to 2 years. And you can see that the 2 years rate is about 20% higher than 6 months rate. And then gradually the interest rate keeps going high. It gets higher and higher. And the last row, the 2 year rate is only 10% higher than the 6 months rate. And actually, after a few months, the interest rate drops. In this case, because the interest rate will go higher, when you borrow money, you want to borrow with a higher rate. So if you borrow at 3.88 for 2 years, then it's cheaper than you borrow short term and keep renew because you lock in a very low interest rate. And now let's look at 10 years later, from 2003 to 2005. At that time, the interest rate is very low because of the dot-com bubble happened 2 years ago. So if you look at the 2 year rate, it's much higher than 6 months rate. It's more than 20% higher. It's like sometimes it's 90% or 60% higher and so on. And during this period, the interest rate also increases, which means if you can lock in a good rate for a long term, it's better. So although in the short term, if you look at the 2003 March, in the short term, 1.2 is lower than 1.5. But if you borrow for 2 years, this 1.5 interest rate gonna keep your cost of borrowing money very low. Okay, now let's pick another period, 1996 to 1998. During this period, the interest rate stays flat. It doesn't change much. And then the 2-year rate compared to the 6-month rate is a little bit higher. It's higher by like 7%, 5%, 10, 15%. So all of these are relatively smaller difference. So when everything stays flat, the 2-year rate is not much higher than the 6-month rate. So let's re-ask the question. During a normal yield curve, which box expiration do we need to choose? And the principle, of course, is assume we can predict the future. If the interest rate will rise, we should choose longer term. And if interest rate stays flat, we can choose short term. And based on the examination of some of the historical numbers, I have an approximate criteria. So basically, if the 2-year rate is higher than 6-month rate by R%, then if this percentage is more than 20%, it's more likely that interest rate may go higher very soon. So although it's higher, we want to choose a longer term to borrow and hope to lock in a good interest rate. But if R is less than 20%, then interest rate might stay flat for a while. We can choose short term, and when the short term option expires, we can check again. But when you choose a short term, all those interest rates actually are very close. So even if you choose longer term, the difference may not be that much. And it's relatively safer because if the interest rate goes up, even when R is less than 20%, you also locked in a relatively low interest rate. So a very simple rule, to be safe, you can always choose the long term to borrow. And if you look at both the normal yield curve and inverted yield curve, you can have a simple criteria for all cases, which is counterintuitive. Basically, you pick the one with higher interest rate because we assume the market set it high for a good reason. So we pick the high one, and in the long run, this simple rule might lower your cost of borrowing money. Okay, that's all for today. Thank you.